Good evening. Please come to IFRS 12. What is IFRS 12? Disclosure of interest in other entities. So in this standard, we are only going to learn about disclosure standards, disclosure part. And this gives you disclosure relating to subsidiaries, associates and joint ventures. Those other three standards dealing with subsidiaries 110, associates and joint venture 28, joint operation 11, and even investment entities which are exempted from the requirement of consolidation, they will also follow this standard also for disclosure purpose. The purpose of disclosure requirement is to help the investor to understand the financial statement better. Second, they can understand the risk and return better, and then they can take a more informed decision. So that is the objective of this standard. So this standard is the basis for disclosure of interest in other entities. What do you mean by interest in other entities? That means where we have control, significant influence, joint control, and it also requires some disclosures to be given about unconsolidated structured entities. Like for example, investment entities do not consolidate. Even a reporting company do not consolidate certain entities subject to your exemption 110 under IFRS 10. So what disclosures will you give with respect to those entities which have not been consolidated? So you can say this is like the scope paragraph of the standard. Disclosure of interest in subsidiary, associate, joint venture or other unconsolidated structured entities. Other IFRS only provide for accounting of these entities. Like example, IFRS 10, IS 28, IFRS 11. The disclosures are to be based on the disclosure objectives set by the standard. So now we'll first see some important definitions. There are three important definitions in the standard: structured entity, income from structured entity, interest in another entity. Okay. What is a structured entity? An entity that has been designed. An entity that has been designed so that the voting or similar rights are not the dominant factor in deciding who controls the entity. So they may be specially designed entity where voting or a similar rights are not the dominant factor in deciding who controls the entity. So control can be evidenced by other factors also, such as when any voting rights relates to administrative task only and the relevant activities are directed by means of a contractual arrangement. So that is structured entities. Voting rights are not dominant factors. The decisions are taken by contractual arrangements, like venture capital funded enterprises, where the voting rights may not be dominant factor, but the contractual arrangement may be the dominant factor in determining the relevant activities. Next definition is income from structured entity. Income from structured entities includes but is not limited to. Why they are discussing this kind of definition? Because you will find in the disclosure requirement there is some reference of structured entities and income from structured entities. So income includes but is not limited to recurring and non-recurring fees. Then interest, dividend, gain or losses on the remeasurement or derecognition of interest in structured entities. and gain or losses from transfer of assets and liabilities to the structured entities. So these are the income from structured entities which are specially designed. Now next important definition is interest in another entity. Normally when I say interest, it means we are holding equity share. But the definition is not only restricted to equity share. It means any form in which we are associated with other entity which exposes us to the variable return. Then we have an interest in other entity. An interest in another entity refers to contractual and even non-contractual involvement that exposes an entity to variability of return from the performance of the other entity. Example, the holding of equity instrument is the simplest example, but it also includes holding of debt instrument. It also includes any other form of involvement such as provision of funding, liquidity support, credit enhancements and guarantees. Even credit enhancement is a type of guarantee only. That is, you take the responsibility of any kind of risk, credit risk. So this is also going to expose you to variable return, and therefore it will be called interest in other entities. It includes the means by which an entity controls, jointly controls of or significant influence over the other entity. So even though the definitions are designed in a complicated way, but prima facie the interest in other entity in this chapter would mean control, jointly control or significant influence over the other entity. And then there is a clarification. An entity does not necessarily have an interest in another entity solely because of a typical supplier or customer relationship. Otherwise we can say we have an interest in other entities in so many ways. That is not covered. It has to be investment through equity, debenture, guarantees, funding arrangement, credit enhancement, and this like this. Now let us come to disclosure parts. This is a pure disclosure standard. No accounting measurement involved. So you can keep your calculator close today. So when you are doing consolidation, etc., you may have made certain assumptions and judgments. Like for example, in determining control also, we may involve judgment. So an entity discloses information about significant judgment and assumptions it has made, and any change in those judgment and assumptions in determining. Now where do we require judgment? Many times the judgment is required to check whether we control the other entity, especially when you are holding less than 50%. You are close to say 40, 45, and you have to apply IFRS 10. So you have to see whether do I really control the other entity, and that time you have to see what is the shareholding pattern. Is there any other group of entities which are holding good number of shares? And at that time your judgment will be required. If you have made any judgment, disclose. And then one more area where we require judgment is to check whether there is joint control of an arrangement or significant influence over another entity. Some problems we have discussed in this standard IS 28. You are holding 8%, your subsidiary is holding 6%, together 14%. But then you have to see whether significant influence exists or not. If yes, then you have to give the disclosures. And then the type of joint arrangement. Sometimes the complication arises in a joint arrangement, whether it is a joint operation or whether it is a joint venture, especially if you create a new entity. Because a legal entity created can be joint operation or can be joint venture. When the parties are allowed to take separate assets and liabilities, then it is a joint operation. When the parties have interest in net asset, then it is a joint venture. But sometimes that arrangement can be complicated also. So therefore, If you have suppose decided to show it as a joint operation, then what is the basis for that decision? What is the assumption you have made? If it is, suppose you decide to show it as a joint venture, disclose your judgment, assumption, etc. Now next question they may ask is, what are the disclosure requirement relating to interest in subsidiaries as per IFRS 12? Copy paste this version. Just I need to tell you that our notes are edited version, okay? The original text runs into many pages. So those who are interested student will read from the bare text of IFRS 12. How many of you are interested? None. Okay. An entity shall disclose information that enables user of the consolidated financial statement. So what are the disclosures relating to subsidiary? Give such information that will help users to understand composition of the group. Composition of the group means parent, subsidiary, subsidiary of subsidiary. Okay, so whatever is that group structure, who is holding how many shares in the other entity, if possible you give that disclosure. And second, the disclosure should help users to understand the interest that NCI have in the group's activities and cash flows. That means what is the percentage stake of NCI? What is their share in net asset, which you disclose in balance sheet? What is their share in the profit and total comprehensive income? What is their share in the cash flow? And then the disclosure should help users to evaluate the nature and extent of significant restriction. Nature means what kind of that restriction is, and extent means to what extent, how much of significant restriction on its ability to access or use asset and settle liabilities of the group. So any restriction on use of asset, settlement of liabilities, give disclosures, because this will help us to understand the risk and return of that group. Useful for the stakeholders, such information. When you give loan to a group, one has to see whether those assets can be disposed or not, in case if I have to recover my money. Nature of and change in the risk associated with its interest in the consolidated structured entities. Structured entity, what we had seen earlier in the first definition only. What is the nature of risk and what is the change in the risk with respect to such consolidated structured entities? Disclose. The consequence of change in ownership interest in a subsidiary that do not result into loss of control. Prior knowledge of IFRS 10 will be useful. If you sell some share in the subsidiary, there is a change in ownership interest. And there are two possibilities. No loss of control, loss of control. If there is no loss of control, you have to give the disclosure. What is the effect of that? So you can just say that our stake has reduced, NCI stake has increased. And then consequence of losing control of a subsidiary during the period. So here you have to disclose how much was your profit or loss, basically, on the disposal of the subsidiary. Now next is tick mark, disclosure about interest in unconsolidated subsidiaries. Now in IFRS 10, an investment entity, you have learnt in the last part of this standard, is required to apply the exception to consolidation and instead account for its investment in subsidiary at FVTPL, correct? So investment entities are those whose business is primarily to earn income in the form of dividend, interest, capital gain, and they manage the investment on behalf of other investors. They are allowed to show investment at FVTPL and they are not required to do the consolidation. So what are the disclosure requirement for investment entity? Where an entity is an investment entity, the standard requires additional disclosures, including. Now including means you can add something more also. And even in our notes we have done some editing. The institute text is very lengthy. Okay. And there is nothing much to be explained except that we just need to read it. The fact that the entity is an investment entity. So first disclosure you have to mention that we are an investment entity. So if you are an investment entity, investor will ask, how have you come to that conclusion? So second line you have to disclose information about significant judgment and assumption it has made in determining that it is an investment entity. So how have you come to this conclusion that you are an investment entity, and specifically where the entity does not have one or more of the typical characteristics of an investment entity. Right? Then continue the disclosure requirement of investment entity. Details of subsidiaries that have not been consolidated. And what are the details you have to give? Name of the subsidiary, the place of business, the ownership interest held. Then detail of the relationship and the certain transaction between investment entity and subsidiary. So what are the disclosures you will give under this detail of relationship and certain transaction? Example I have written, restriction on transfer of funds, commitment, support arrangement, or any contractual arrangement. Information where an entity becomes or ceases to be an investment entity. Now what are the disclosures you have to give here? When an entity becomes investment entity, you have to give disclosure. When an entity ceases to be an investment entity, then also we have to give disclosures. You just mention here, refer IS 27 also. There also we have discussed the disclosure. Refer IS 27. Sir, what is IS 27? We have forgotten. IS 27. Separate financial statement. Last one or two paragraphs there I had given disclosure about investment entities also. So that also has to be read here. An entity making these disclosures are not required to provide various other disclosures required, because you are not following consolidation. So then you don't need to give previous disclosure, interest in subsidiaries. Okay. Because you are not doing the consolidation work. So there is no question of loss of control, change in control, etc. And now the next disclosure tick mark, interest in joint arrangement and associates. Two standards deal with joint arrangement and associate, IS 28 and IFRS 11. Those two standards do not talk about disclosure requirement. Now here we have written quite briefly what are the main disclosures requirement. An entity shall disclose information to enable users to evaluate the nature, extent and financial effect of its interest in the joint arrangement and associate. So you have to give so much disclosure that investor can understand what is the nature of your interest in that joint arrangement, what is your extent, means percentage, etc., and financial effect. What is the share in the profit of joint venture, associate that you have recorded? All this disclosure should be there, including the nature and effect of its contractual relationship with other investors with joint control of. So in case of joint venture, two or more venturer form a joint venture. Give the nature and effect of its contractual relationship with other investors also with joint control of or significant influence over, joint arrangement and associate. And then from risk point of view, the nature of and changes in the risk associated with its interest in joint venture and associate. In all the disclosures you will find one line is the risk and changes in the nature of risk. Last disclosure, interest in unconsolidated structured entities. An entity shall disclose information that enables users of the financial statement 1. To understand the nature and effect of interest in unconsolidated structured entity. Under IFRS 10, you are allowed not to consolidate certain entities. Okay. So give disclosure so that you can understand the nature and extent of interest. And second, again risk. Nature of and change in risk associated with interest in unconsolidated structured entities. This standard is over. For more details, read the bare text of IFRS 12. Okay, you can download from the institute website or IFRS website. Are you interested? Seems to be no.